Hey everyone, welcome back to Corporate Decoder, the place where we slice and dice financial documents to uncover the real story. And today we're looking at Cardinal Health. And let me tell you, they've been busy securing some important funding. Cardinal's Health just inked a new credit deal, and while it might sound like everyday corporate jargon, understanding this kind of agreement can tell us a lot about a company's plans and confidence in its future. Let's dive into what this deal really means. And before we get into the nitty-gritty, if you find value in decoding these complex corporate filings, make sure you're subscribed. Also, for deeper dives and discussions, we've got a fantastic Discord community linked in the description below. Alright, so Cardinal Health Inc. has signed this thing called a 364-day credit agreement. Think of it like a short-term loan promise with a bank. In this case, Bank of America, they did this right after their previous similar deal expired. The main takeaway here is that this agreement gives them access to a cool $1 billion in what is called revolving credit. Now, revolving credit is like a credit card for a company. They can borrow money, pay it back, and then borrow it again up to a certain limit. This is super important because it means they have flexibility to manage their cash flow. This new credit line is good until the 6th of October 2026. That is a little less than a year, and that is why it is called a 364-day agreement. It also has a neat feature where if there is any money still owed on that date, they can choose to turn it into a longer-term loan that they'll pay off a year later. This gives them even more control over their debt obligations. Now, of course, with any loan, there are rules. Cardinal Health has to keep its finances in check. One key rule they agreed to is about their consolidated net leverage ratio. To put it simply, this ratio is a way to figure out how much debt a company has compared to how much money it makes. They have to make sure this ratio does not go above 3.75 to 1. What does that really mean? It means for every dollar of earnings they make, their debt shouldn't be more than $3.75. This is a pretty standard financial covenant, meaning it's a promise they make to the bank to keep their borrowing at a manageable level. If they were to breach this or other promises, it could lead to what are called events of default, which is never a good situation for a company. So, what are they going to use this massive $1 billion credit line for? The report tells us it's for general corporate purposes. This is pretty broad, but it usually means things like paying everyday bills, funding operations, or even supporting their commercial paper program. Commercial paper is basically short-term debt that companies use to finance their immediate needs, and this credit line acts as a backup if they need it. It signals that Cardinal Health feels pretty confident in its ability to manage its day-to-day operations and doesn't foresee any major cash crunches, at least not in the near future. Now, to read a lot of procedural information in these filings, like where the company is located and its basic registration details. For instance, we see their address and they are incorporated in Ohio. They also have a commission file number and an IRS employer identification number. These are standard identifiers for any publicly traded company. We also have to note the securities they have registered, like their common shares traded on the New York Stock Exchange under the ticker symbol CAH. For the most part, these details are about the nuts and bolts of being a public company, and don't offer much in terms of strategic insight, but they are important for regulatory purposes and for investors tracking specific details. It is also worth noting that some of the banks involved in this credit deal might have done other business with Cardinal Health in the past, or might do so in the future. They provide services like lending and financial advice, and Cardinal Health pays them for these services. This is pretty common in the corporate world. It's just a standard disclosure that reminds us that these financial relationships can be multifaceted. And as with most modern filings, we see the mention of interactive data files. Specifically, this cover page interactive data file embedded within the inline XBRL document. This is basically how companies present their financial information in a way that is easier for computers and analysts to read and process. It makes the data more accessible for broader analysis and reporting, ensuring that the numbers are readily available for investors and regulators. Looking at the big picture, this filing from Cardinal Health Inc. is primarily about reinforcing their financial flexibility. The new 364-day credit agreement provides them with a substantial $1 billion line of credit, which is a strong indicator of their operational stability and their access to capital markets. The covenants, particularly the leverage ratio, show that they are committed to maintaining a healthy balance between debt and earnings, which is crucial for long-term financial health. This kind of agreement is typically a sign of management confidence, suggesting they anticipate needing these funds for strategic initiatives, growth, or simply to maintain robust operations. It's not a sign of distress, but rather proactive financial management and a commitment to operational readiness. What are your thoughts on this new credit agreement for Cardinal Health? Does it signal confidence or caution to you? Let me know in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more deep dives into corporate finances. And don't forget to join our Discord community for more in-depth discussions. Thanks for watching, and I'll see you in the next one.